Welcome to Talk Tickers, where we dive deep into the earnings calls that are really moving the markets. And today, man, we are looking at Lemonade. They just dropped a massive third quarter beats, and it literally sent the stock into the stratosphere. So yeah, take a look at this. After their Q3 earnings report dropped on November 5th, Lemonade stock just exploded. We're talking a close of around 35% higher, and on huge volume too. So let's get into it. What exactly was behind this incredible rally? So what was going on here? Well, let me tell you, this wasn't just some random short squeeze or, just market momentum carrying it along. No, this was a story all about the fundamentals. For the first time, in a big way, the market really saw it, accelerating growth, these record low loss ratios, and most importantly, a clear, believable path to actually making money. All right, so first things first, let's talk about the headline numbers. This is what everyone saw first, what really grabbed the market's attention before the opening bell. And honestly, it was a total clean sweep. Okay, so check this out. On earnings per share, they posted a loss of 51 cents. The street was expecting a 72-cent loss. That's a huge beat. Then you look at revenue, they beat by about $10 million, just crushing expectations across the board. But here's the kicker for me, that adjusted EBITDA loss. It was nearly cut in half from last year. That right there shows some serious progress on the bottom line. And when you dig a little deeper, story gets even better. Look at these KPIs. In-force premium, that's basically all their policies in force, grew 30% to over $1.1 billion. That's fantastic. But the real showstopper, look at gross profit. It more than doubled year over year, 113%. You combine that with a record low gross loss ratio of 62%, and boom, that's the core of the bull case, right there. So the numbers are obviously great, but the real story here, the thing that got everyone so excited, isn't just what they did, it's how they did it. Because this quarter, we got the clearest evidence we've ever had that Lemonade's whole AI-driven model, well, it's working. It's creating some serious operating leverage, and it's doing it at scale. Just look at the gap between these two bars. It tells you everything you need to know. Revenue growth is at 42%, which is great, don't get me wrong. But look at gross profit growth, 113%. It's growing nearly 3 times faster than revenue. That is the textbook definition of expanding margins and operating leverage. It means every new dollar of revenue they bring in, way more of it is dropping straight to the profit line. In this slide, this just illustrates that point perfectly. Look at this 2-year change. On one hand, you've got gross profit absolutely surging, up 261%. Insane. And on the other hand, their operating expenses have barely budged. We're talking single-digit increases. You know what that means? They've basically turned what should be variable costs into fixed costs. And that, my friends, is the holy grail for an AI-first company. Okay, so to really get how they're doing this, we need to talk about a specific insurance metric. It's called the Loss Adjustment Expense Ratio, or just LAE ratio for short. All it is, really, is a measure of how much it costs an insurance company to actually handle and process its claims. And Lemonade's LAE ratio, it's just 7%. Now, to put that in perspective for you, the big established insurance giants, they're usually sitting around 9%. And that's with their massive economies of scale. So this is just concrete proof. It shows that Lemonade's AI system, the one that handles most of their claims without a human even touching them, it's not some gimmick. It's a real, durable, competitive advantage. All right, so that's the performance, but the big question then becomes, how does this translate into the future? A great quarter is, well, great. But what the market really wanted to know was, is this momentum sustainable? And you know what? Management delivered. Big time. They raised their full-year revenue guidance by a pretty significant amount, and they signaled that the improvements on the bottom line are going to keep coming. This sends a really clear message. This was not a one-off quarter. They fully expect this momentum to continue. But maybe the most important thing they did was lay out a crystal clear timeline to profitability. Look, they already hit positive adjusted free cash flow this quarter. Now, they're officially targeting positive adjusted EBITDA for the fourth quarter of 2026. That is huge. It gives investors a firm date, something they can really anchor their expectations to. So, putting it all together, what does this mean for the stock from here? All right, let's get to it. Here's our next call on Lemonade. First things first, you've got to understand how management thinks.
The CEO, Daniel Schreiber, he basically said this, and it's key. They are not trying to get the absolute lowest loss ratio percentage. No, they are trying to get the highest number of gross profit dollars. What that means is they're willing to make a trade. They'll accept a slightly higher loss ratio if it means they can bring in way more absolute profit. It shows they're disciplined but also aggressive about creating long-term value.
So when we look ahead, we see a bunch of potential catalysts. For one, the stock has a ton of short interest. A quarter like this, that can absolutely trigger a massive short squeeze. Then you've got them continuing to improve their auto insurance business, they're expanding into new states like Pennsylvania, and honestly, just executing on the higher guidance they just gave us could be enough to keep pushing this stock higher.
So, here's the bottom line. We are initiating coverage on Lemonade with a rating of outperform. Look, this quarter wasn't just another beaten race. It felt like a real inflection point. The whole story has shifted. It's no longer a question of can their AI model even work. Now the question is just how profitable can this thing get? The path forward is finally clear, and that leverage in the business model, it's just undeniable.
And as always, just a quick reminder that this has been an analysis for informational purposes only. This is not financial advice.